Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here with Heather Marchant.
Yep.
And, man, today we're going to continue on our discussion about syndications, because we got we got into that a ways, but we didn't actually finish it up.
We felt like we were rushing at the end, and we're like, oh, we can finish all the stuff we wanted to talk about. And then it felt too rushed, I think. So we wanted to just.
And before we jump in, if you're new, first time you've listened to the show, this is a part 2. So you should probably not start with this one, honestly, but we're glad you're here. You should probably go listen to part 1 first, and then you should listen to this one. Either way, you should subscribe and share us with all your friends out there. You can find us at getrealestatesuccess.com, and we'd love your feedback.
That's right. We have a lot of fun up in here.
Yeah, we're going to have some fun up in here today, and we're going to talking about syndications. And this is fun. I really enjoy these. They're a lot of fun.
I've seen that in you, actually. Yeah. You have a lot of fun with this. I think the learning side of it is really fun, and the analyzing deals is really fun. So
we'll talk about some of that today. And then the part that I really love is deal structure. I love trying to solve problems and create deals. I mean, I genuinely, my brain is geared to solve problems, and I really enjoy that. And so a syndication really is just it's just this big, huge challenge, and putting all the pieces together is really fun.
Yeah.
The last time we talked about what a syndication is, we talked a little bit about private placements. We talked about a lot of terms, like a lot of general partners, limited partners, and, yada, 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 and all the different kinds of things that you can do, mostly with respect to apartment buildings. And we're going to stay on that track. And as we use any more terminology that we haven't defined, we will define it as well, because we're going to move on a little bit from where we were. And we're going to talk a little bit about when you're looking at a deal, what are some questions that you should ask, about structure, about the deal itself, things like that. We talked briefly about these things last week. It was really, really quick. So we're going to talk a little bit more about it. And dive a little deeper into some of this stuff.
Yep. I think we talked about, you said number 1, the first thing that's the most important was to vet the people who are in charge, the general partners, because they're the ones making the decisions. They're the ones solving the problems. And so it's giving your money to someone who's going to help you with that. So you probably should know a little bit about them and their background, right?
Definitely. And if you don't, you should, you should do some research, right?
Yep.
Really important.
I mean, there's something to be said about trying someone who's new, right? And you got to start somewhere, right? Your first syndication deal, but they should be able to, I've seen it with you, that, work with someone who doesn't have as much experience, maybe bring on someone as another general partner who has some experience. I mean, wouldn't that be more ideal than working with someone who's straight up newbie with no?
I think most people who get into a deal like this do that. Any intelligent person jumping into something that they don't know how to do is going to bring someone on who adds value, and that value is probably helping them learn how to do the deal, right? How to make sure that this thing comes off without a hitch. And so, that would be something I think that would be beneficial to look for sure. Let's just kind of go. Let's go through some things that I think that people should understand. You can, some of this is going to be in the offering memorandum. Some of it's going to be in the private placement memorandum. Some of it's going to be, in the company agreement. But you need to know these things. So if it's not in those, and you're just lazy and you want to just ask the sponsor you're talking to, that's fine. But you should know these things. You should know how often and what type of reporting. I mean, you should know that. Generally speaking, that corresponds with when do I get paid? Because that should be also something that you should be asking. You should understand the deal structure, which we'll talk about in a minute, but you should also understand when you're getting paid. Is it quarterly? Is it monthly? Is it annually? Is it whenever they want? And then, whether you're paying me or not, what kind of reporting do I get? Am I going to know what's going on at the building? Do I get the financials? And the answer to both of those should be yes. You should get any data that you want anytime you want it. That should be where, anybody who answers anything other than that, probably shouldn't do a deal with them. You should get reporting, and on a pretty consistent basis. So we do it quarterly. That doesn't mean that's the only way or the right way to do it. We just do it quarterly. I find that's a pretty good time frame.
I feel like most of them do quarterly. Is that not the case?
I think most do. It's a pretty good time frame. But some people pay monthly, depending on how the deal is structured. And some people don't pay at all for a year. If you're doing a new construction deal, sometimes you don't make any money because you're building, right? There's no money to pay out because there's no income. And so, may not make any money, but you should still get reports. You should still understand what's going on with the property during that year.
If you're not getting money, where's the money? Like, you should know that.
Yeah, exactly. How long, I get the question, how long is my money going to be tied up? Quite a bit. That's a really important one. You should know what the term is. And, if you're investing in a property, you understand, this is another really important thing that I find that I have to explain quite a bit and over again for some people. And that is that this isn't a loan. This isn't like principal and interest payments. That's not what this is, right? This is, you are investing in a company. You're getting distributions.
Really,
it's I get emails and they're like, "Hey, when's my interest payment?" Like, what? And so when I get emails like that, I think it feels, to the investor, when I reply, I think it feels like that's not what I meant, but it's important. If I answer that and say your interest payments are coming, in a couple of weeks, well, then I've just agreed with them that it's an interest payment. It's not an interest payment. This is not debt, unless it's structured as debt. It's not debt. This is coming to you in the form of distributions that are going to show up on a K-1 at the end of the year because you're an owner. So
it's a really, really good clarifying point.
Yeah. So how long is my money going to be in? Well, if it's not debt, it doesn't really have a fixed term. It can have inside of the documents, but a lot of times it's not. It's kind of a range, 18 months to 24 months. It's going to take us to turn around, before we sell, or 3 to 5 years, or 5 to 10 years, or 10 to 20 years. It could be any number of things, but you need to understand, is this a short-term deal? Is it a mid-term deal? Is it a long-term deal? What's the play? How does all that work?
What are your options if you had a life circumstance change and you need to get out? What does that look like? How does that work with a syndication?
Yeah, absolutely. You can't just say, "Hey, I want my money back." It's not the way it works. You could sell your shares. So the way I structure mine is that the person can sell their shares to someone else. Everyone in the fund itself has first right of refusal on those shares. Then other than that, the general partners still have to approve anybody who's coming in. So it's not as easy as just, "Hey, I want out." That's not the way it works. Well, generally, some of them may have those kind of options, but nothing that I've seen does. This last round where I'm raising money, I think I've had a couple of people ask me if I guaranteed a return too.
Oh, really?
It's the first time that's ever happened on a syndication, but there must be syndicators out there guaranteeing returns. I think you and I have talked about this before with just with respect to like turnkey providers who are guaranteeing things, right? Didn't we talk about that? I'm sure we did.
We did. It's been a while though. So I think reiterating it for new listeners might be good. I mean, if you guarantee is only as good as, the person you're getting it from, it doesn't necessarily mean that circumstances can't change. That happens with rental properties all the time. They aren't able to perform on the guarantee, and then what good did it do you? Right. So there's,
I mean, look, in my opinion, it's not an investment if there's a guarantee. That's why life insurance isn't a guarantee. It's not an investment, because there's a guarantee. If you get a guarantee, it's not an investment. Sorry, it's just not. Investments.
That's a good point.
Investments have risks, not guarantees. So no, I don't. And anybody that does, it's my personal belief that you should run away from people who guarantee. If you got to ask yourself why. Why are they guaranteeing? Do you need to guarantee something because the deal isn't that great and I'm not going to say yes unless you guarantee it? Like, what's the purpose of guaranteeing something? Either the deal's good or the deal's not good. Why do I need to guarantee it? Why would they guarantee it? I don't know. Just food for thought, I guess.
Devil's advocate right there.
Yeah. So along those lines, like what are the risks? What's the upside? What's the downside? So every sponsor is going to tell you what the upside is, all of them. They should also tell you what the downside is. And if they don't, you should ask them. And then the downside should seem like a downside. It shouldn't be like well, this is the biggest no-brainer I've ever seen, but I guess something could go wrong. Like, I don't know. I mean,
a lightning could strike.
Right. Look, this is real estate. And if they say, I think somebody asked me what could go wrong. And I'm like, look, when you get the private placement memorandum, when you read through all of the crap in there that could go wrong that I have put in there, if you still want to invest, literally we list out just about everything that could possibly happen to your investment. And then ultimately, what they should say is that you could lose your money. Because that's the truth. You could lose your money. Now,
which is why this is for accredited investors who have potentially
that's why there's a private placement.
Yeah.
That's why it's SEC regulated. Yeah. So if some sponsor starts giving you a hardcore sales pitch about why there's almost no risk to the deal, and they don't tell you what the real risk is, the real risk is you could lose your money. That's the real risk. There should be enough upside to offset the risk. That's how you look at investments. Some are safer than others, but none of them are without risk, period. Yeah. Hopefully that was blunt enough. It's important to know how the sponsors make money. It's important to know when the sponsors make money. Because I think I said in the last episode that the money partners, the limited partners, should make their money first. Right? They should be paid first before the sponsors are paid. That's important. How they structure their payouts is important and indicative of what you can expect from them. So, for what it's worth.
If they don't get paid, why are they going to put? Like I think you said this last time. If they're not going to get paid well, why would they put time into making sure you get paid well, right? So, there has to be an upside for them.
And they should be yoked to you and your success. Everyone should be yoked together, but people who put the money in should get first money in, first money out. In my opinion, that's the way it should work. Let's talk a little bit about structures, right? I think last time we talked about the story. Before we go into structure, I think we talked about the story of the property.
Yeah.
And that's really important. Why is the seller selling? Tell me the story from beginning to end, right? What's the problem? How are we solving the problem? And then what's the upside to us solving the problem? Tell the whole story all the way front to back. And I think I said last time that one of the reasons that we want to do that is the same reason. Yeah. Cause I talked about my buddy's podcast and So, okay. So we talked about all of that. Make sure you do that. Okay. As far as the deal goes, you probably want to know how it's priced. Is it priced comparable? What are the rents? Are the rents low for the area? We talked about cap rates last time. And I think I actually talked about, we spent some time on cap rates because for some reason it's really a hard concept for people to understand, but you should understand what the cap rates are. What's the going in cap rate? What's our targeted exit cap rate? And where are we right now? You should understand a little bit about the financials. Like, is it a mess right now? Is that what we're cleaning up? Is the property what we're cleaning up? Are we doing both? Is the property running really well? It just has a little bit of upside because the rents are a little bit low. I mean, what's the real story here? And then what's the shape of the property? And the most important shape of the property is the really expensive stuff. Roof, major mechanical systems, that kind of stuff. The things that can really upend a project. And then what's the budget for all that stuff? And where's the money coming from? What's the loan look like that we're getting on the property?
Yeah, I think one interesting factor that I've seen with your syndications is most often you've participated in them, right? That you're a player in that you're putting your money into it as well. That it's not just, hey, give me your money. I have this cool idea. I have a cool idea and I believe in it. I'm going to put my own money into it. So,
yeah. Now, do I think that the general partners need to fund most of it and they're looking for a little bit of scratch from somebody else? No, I don't think so. I think generally I put money in, kind of commiserate with what everybody else is putting in. I'm just I'm a limited partner with you guys, and I'm the general partner who's going to do the deal too. And then I think that also yokes them, right? I'm getting money, first money in, first money out. And I'm also got a little bit of upside on the back end, right?
That's pretty smart, actually. Yeah.
Yeah. And if I'm a limited partner, I want to know, like, what should I expect return first year? First year is the trickiest year because that's when we're doing all the cleanup and everything. How's the property actually running? Are we going to get paid first year? And when are we going to get paid first year? What's the projections? How quickly are we going to be able to turn things around if we need to? Or is the property operating right now sufficient that it can pay us out? Right. I think one of the things to take into consideration in the market is what is it that's around it as part of the story that helps the story? Have we calculated taxes based on our new purchase price? A lot of people miss that.
Yeah.
I mean, if the old people bought it for $1 million and you've got taxes in there based on their $1 million, and you're buying it for $4 million, well, that's going to be that's going to be fun in a year when you get your tax bill.
Yeah, I've seen your deal structures too with minimum investment, a little bit different, different every time, so to speak.
It is different, but based on the property and based on what the raise is. If it's $1 million raise, that's a pretty small raise. So I don't have to have a big, huge minimum where I can allow, more investors who don't really want to try it out. But if I'm raising $2.5 million, $3 million, $4 million, I mean, I got to have a lot larger minimum because I don't want to have 1 million investors that I have to deal with,
And
so
give reporting to,
each deal is different. And these are also things, right, you should be asking. What's the minimum investment? And how much are each of the shares? What's the maximum investment? Sometimes they have a maximum investment. And that usually that's because of financing. Because if you own over a certain percentage, you have to go on the loan.
Oh, interesting. Okay. I didn't know that.
You become a de facto general partner, whether you want to or not. So if you go back to all of the things that we've already talked about as far as area goes, those things all apply here. And, you can go back to the show. We've probably talked about it 2 or 3 times. All the different things, right? We want to talk about schools and shopping and, jobs and all of that stuff. All of that needs to be around where you are. Okay. You should have some kind of a report that they're going off of that can corroborate what they think that their rents are going to be. We use CoStar. It's a great reporting. And, CoStar gives tons of information about both the property itself and about the surrounding properties. It also tells you how many properties are being built around the area, so you can tell what your competition is going to be in the next year or 2 years. Whoever the sponsor is should have something like that is corroborating what all of the market statistics that they're coming up with, like the vacancy rate and the rents and comparable sales and all of that stuff.
I think understanding the rents that you're projecting, if you're going to raise rents, you want to understand what the median income is in the area. So, the rents are affordable for a good part of the population, right? That you're not limiting who your tenants are. So making it harder to raise rents, right? So all that little nitty gritty analysis can play a big part in how the property performs long-term.
Right. And then, deal structure finer points. Is there an acquisition fee? Is there a management fee? What does the waterfall payout look like? And if you imagine a waterfall, it hits different points at different places, right? As it flows over. Well, it's the same thing. So how does the waterfall look? And that goes back to who gets paid first. Well, who gets paid first? How much? Who gets paid second? How much? How much upside do we get? And then why did we structure it that way? Because, almost all of mine are structured a little bit different. And each one is structured a little bit different because of the terms that we've negotiated in the deal. And they're not all the same. I think we talked about a couple of them last time where the deal structure was really heavily weighted towards the limited partners on on kind of a construction type of a deal, which seemed really risky for the general partners, in my opinion. Well, the exact same thing can be said for some of the structures relating to the limited partners. They can be really heavily weighted towards the general partners. So much so that they're taking money all over the place, right? And they're not giving out fair returns. That said, sometimes I get emails from people who the money should make a lot of money. Well, the money should make a lot of money in the case that there's limited supply of money and a lot of deals. This is the same thing that we basically just talked about in the last episode about supply and demand. Well, right now there is a ton of money and there are almost no deals. I mean, so which way is it going to be heavily weighted? It's going to be more heavily weighted, right? What's not seen, I think, to a lot of people when they're looking at private placements and syndications is the work that goes in up front before there's even a syndication. The one that I just did, we've been working on that for 3 months before we even brought it up to be a syndication. We've already spent somewhere around $30,000 on that deal to make it a deal before we even started the syndication. We've already flown there. We already did the due diligence. We've already done a lot on that deal. And to get that deal, we had to look at a ton of other deals, which we've been doing. All right. And so one of the other benefits of buying into syndication is you don't have to do any of that stuff. You're buying into a ready-made deal. It's already there. Somebody's going to do it. Hopefully somebody's already done a lot of legwork on the deal.
Because I have a lot of clients that love real estate and they love the capabilities of real estate. They love that it's a secured asset. They don't want to be tied to the stock market so much, right? But then when it comes to owning rental properties, that either overwhelms them or when there's a problem, it just totally messes with their mind. Like, this is supposed to work different and there's an upset and things happen and I have to spend my time. And so syndications are really great for people like that, right? Where you don't have to do the due diligence as much, right? You can do your due diligence, like the questions we've been talking about, but flying there and looking at the project, probably not necessary for buying a couple shares.
You know what? Not necessary, but I had one of mine where I had 4 of the investors, and they all kind of knew each other from all different parts of the country, but they all flew in. It was fun.
Oh, really?
It was fun. And they actually flew in on the day when we were doing due diligence.
Oh, I remember that.
They helped with due diligence. It was a blast, actually. Plus, it made it way faster because we walked every single unit of a lot of units, well over 100 units. And we were able to, three or four, I can't remember, but there was 3 of us. And so there was 3 teams that get to go walk instead of 1 team. They got to go walk the units. And so I think it was really good for them too, because they got to learn, what does due diligence look like? What are we looking for in each one of these units when we go in? What are we looking for in the exterior? Who all's there on site? Like, which contractors do we have there looking at what? Because when we go to do due diligence, I mean, I'm not qualified to look at the HVAC. I'm not qualified to look at the roof, nor am I going to climb up on there. I'm not qualified to look at those major mechanicals. So we hire contractors to come and look at those who are qualified to tell us, and then to tell us how much it's going to cost to fix them, so that we actually have legit numbers. I am qualified to walk into a unit and look and say, okay, this thing's we got to have new carpet. We need, we need a whole new kitchen. We need new appliances.
There's a hole in the wall.
Yeah. I mean, I'm qualified to do that.
Yeah.
But what I'm not qualified to do that my team can do afterwards is take that list and turn it into something that's financial, right? They can say, this is what all of this stuff costs based on what we found. This is what we need to put into this property. Right. Yeah. So, you don't have to come. That doesn't mean you can't. Doesn't mean you can't. Doesn't mean you can't come after the fact too. I've actually had some clients who were in the air, kind of like you, Heather, when you did your, US tour this summer.
True.
Where they're like, hey, we're going to be close. Can we just stop up? I'm like, yeah. So I'll call our on-site management and say, hey, I got a couple of investors who are going to stop by. They want to just tour around the property, take them around, show them the works,
Yeah.
And that's fun because they get to go and see something that most everybody doesn't get to see. So I would certainly never discourage that. Anybody who actually wants to come should come. But no, it's not necessary. And most of the people don't do that. Most of the people, the reason they're investing in a syndication is because they don't want to do any of that stuff. And that's perfectly okay. Nothing wrong with any of that.
That makes sense. So in recapping of a general partner and their responsibilities, from a lot of things you've said over probably the last 2 episodes, you're looking at the deals, reviewing the financials, right? Getting a game plan together, negotiating the deal, going under contract, of course. You have, inspections you mentioned. You're coordinating with property managers as well to make sure what they're going to charge. Vetting the taxes and the numbers to make sure if it's going to increase that you're ready for that and you have a budget for that. Travel to the property, perform due diligence. Trying to see what else. Oh, researching the market as well. And and then once you purchase and own it as the syndication, then you're overseeing the property and the property manager and solving any problems. And then when it comes time to sell, then you're handling a lot of the negotiations on selling, right? Pressure on you.
Everything else that goes along with selling, which is pretty much everything you already said, just from the other side.
That's true.
We usually go about once a year to the property as well. And, we're responsible for hiring and training the teams that are on the ground. So it's not just if you're buying a larger property, you've got on-site people, those people, usually they're employed by the property, not by the property management company. And so
that makes sense.
Those are your employees. Enough. You're paying taxes on those people. You're responsible for helping to make sure that everything is going well on site.
Who typically is coordinating the repairs or things like that? Is it the property manager that mostly owns that?
To some degree, right? We're the ones who direct the work. They're the ones who make sure that the work gets done. And usually, either the management company has contractors that we've used or we have contractors in the area. The one that we just did, we actually have a pretty deep list of contractors in the area that we use because we have other properties there. But in a new area, we would be leaning really heavily on them. But also, we know how much things cost. And so we go in and say, you need to go find another contractor because we're not going to pay them out. We're not going to pay that for flooring. This is what we pay for flooring because we already know what we can get it for in other places. So we're responsible for all of that. And I think then on the front side, things that people don't see, because sometimes you can see some of that in the reporting. But, for instance, this deal we've been working on for 3 months, we put up the deposit. We're the ones who paid for the people to go on site and help us inspect the property. We're the ones who paid the upfront fee for the financing to get the financing moving. We're the ones who, paid for all the people to fly in, our whole team, so that we could do this. Because that's thousands and thousands and thousands of dollars, all before we knew there was a deal. I mean, we can put something under contract. That doesn't mean it's a deal. And in any one of those points, we could shut the thing down, because at the beginning of the year, was actually at the end of the year last year, we did that. We actually shut a deal down, and we had already spent. We had already started with the attorneys to pay for the general partner limited partnership. We had already had our attorneys reviewing contracts and working with the other side. These deals are not just like you go sign a state contract. These are specific deals, right? You pay attorneys, and attorneys talk to their attorneys, and and we had already done our inspections. I mean, we had a lot of money sunk into that deal. And it blew up in renegotiations because we found some things in our due diligence that didn't work. The numbers didn't work anymore. And so we had to renegotiate. But those are costs of doing business for the general partners. So all of that and all of the work that goes into putting one of these syndications together, I think some investors who just don't understand everything that goes into this discount all of that because now here's this deal that's been laid in front of me.
Yes.
And, that's important, I think, to understand as well. So
I think that's great. Good overview.
Those are syndications. Most of them that I've seen, ultimately, your internal rate of return should be double digits from everything that I'm seeing out there. I think you can do really well with them. And as long as you're with a good operator, you can generally speaking, rest assured that it's going to go well. Anyway, on that happy note.
Thank you. No, that's great. I think these are questions I get all the time. So this is an episode I'll send out frequently, I'm sure.
Nice.
So I'm glad we have a recap.
As always, Heather, if people have questions about anything, they should send them in to us so that we can do a show on it. This show came about because of, even part 2 of this show came about because of the questions that we get. So definitely keep answering, or keep asking questions. We'll keep answering them on here.
Mm-hmm.
So if you've been thinking about doing a syndication, well, get out there and make it happen. Till next time, guys.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.